Morning, everybody. I'm getting questions for SDCL already, so good stuff. We'll make sure we'll have quite a finishing session, I think. I've got a bit of news to run through first, so we'll have a look at that. There we go. If I can make the computer work. Oh, there we go. So, sorry. A couple of bits and things I wanted to look at. So first of all, Taylor Maritime, which is doing a bid, and the other one was Harmony Energy, which tries to do a C share and didn't raise very much money, but may not be the end of the world. Taylor Maritime first. It's not been around very long, but it's been doing phenomenally well. That graph is all in sterling, as it says at the top there, and you can see that the NAV and the share price have both done pretty well since launch. But we have now the sort of growing disconnect between the NAV and the share price, which I think is probably unfair. But it's now on a sort of fairly chunky discount, and there's reasonable possibility that that might narrow, but we'll have to wait and see whether that's true or not. It sits within the leasing sector. Now, the leasing sector has not got a great reputation. Partly at first because what was SQN is now SLF realization came unstuck, and then the aircraft leasing funds also had major problems. They've been a bit perkier more recently, mainly because Direct Nimrod Air 1, which is the first of those to launch and only owns one A380, has managed to sell that to Emirates, and that actually pushed up its NAV and its share price, and you can see the really quite impressive 1 year return on the share price, but obviously that's just a rebound from pretty awful numbers earlier on from that. So within there, though, you've now got two maritime ones. So you've got Taylor Maritime and Tufton Oceanic Assets. Oceanic Assets is the slightly older one, but Taylor Maritime is bigger now. And they're both trading on about 31 discount, despite really quite sizable yields. So it does all its accounting in dollars, and obviously the strength of the dollar relative to the pound has been helpful in terms of the NAV. It raised 160 million in cash at launch, but it actually also did a stock swap for some of its portfolio. And that helped the fund expand, and then it raised an additional 75 million in July that year. So, and already at quite a sizable premium to the original IPO price. So it started off with a reasonable size fund, and then it just keeps on getting better and better. So the first trading update in October 21 said the NAV had gone up, and there was enough income already on target to cover the dividend that they've been forecasting at launch. In December, middle of December, they bought this stake in Grindrod Shipping, which is dual listed on NASDAQ and the Chicago Stock Exchange. And they've added to that since, so they now own about 26.6% of it. It's a similar investment vehicle to Taylor Maritime in that it owns what they call geared vessels, bulk vessels. So they're things with basically big cranes on the back that can shift things like coal, grain, that sort of thing. The prices of those have been going up, and Taylor Maritime has been able to sell quite a few vessels from the original portfolio at multiples of what it, well, not multiples, but well, so 1.5 times what it paid for them at launch, which helped fund the original stake in Grindrod. Is going to help fund some of this deal now. They had one problem, which may account part of the thing with the NAV, with the sort of discount rather, and that one of their vessels got stuck in a Ukrainian port, which I'm not sure which Ukrainian port it was. It might have been Kherson actually, because it's still sitting there apparently. But it's not damaged. They got the crew out. That sort of thing, it's probably okay. And then the rest of the portfolio is doing so well that it's not really the end of the world. The Grindrod share price went up, and that got the NAV beyond the $1.70 mark. And again, maybe because it was the Grindrod share price moving that was driving the NAV upwards, was part of the reason why people were slightly dubious about applying the same value to Taylor Maritime. But still, they carried on performing extremely well. So they paid a special dividend in May. So I think they were 8.5% yield in the first year on the IPO price. But more importantly, the yields they're getting on the charters that they've got secured are really quite chunky. So at the end of June, they were at 26% gross cash yield. That's unlevered, so without any kind of gearing going on. This week, they've announced a bid for the rest of Grindrod, and they're bidding $21 a share. And Grindrod is also paying a dividend of $5 a share out to investors before the deal closes. So if you're a Grindrod shareholder, you're going to end up with $26. That $5 a share dividend is obviously helpful for Taylor Maritime because they own a big chunk of it already. So that helps a bit in terms of buying the rest of the company. The whole thing is values Grindrod at about $500 million. But Taylor Maritime, because it's trading on such a big discount and can't raise the equity it needs to fund this deal, is going to do it all with debt. So to do that, it's going to need approval from its shareholders. So there's a vote coming up for that. Altogether, it's going to have 58 vessels. And the debt that they're using will take the loan to value ratio up to about 40%. So that's 40% on gross assets. So obviously that's the conventional gearing is much higher than that. That'd be sort of like 67%. It's also selling one of its vessels for $20 million. That helps. The gross cash yield has come down a bit since the end of June, but it's still 24%. And they've got fairly good visibility on their earnings. So they tend to be hiring these boats out on relatively short charters, but they can say that more than half of the fleet is chartered all the way through to the end of March 2023. So they're confident enough to say, dear investors, if you give us the permission to take the gearing limit up to 40% of loan to value now, then we'll get that down to 30% within 18 months. And you will change the investment policy so that we can do a similar thing in future, perhaps. But if we do it in the future, then we'll get it down to 25% within 18 months. So there's basically saying we're going to carry on using debt and cash flow to pay that down to expand the business. So I think this looks like a really interesting deal, and it does seem to be. It's something a bit different. It does seem to be bucking the trend of the rest of the leasing sector. Obviously, we've got to worry about things like the state of the global economy, but shifting things like grain and coal and stuff around still very necessary at the moment, given what's going on in Ukraine. So I do think it might be quite a good investment going forward, but we'll have to wait and see. I think I've got a question on that. Let's just pick that up. I'm not sure. Tim asked you if the Grindrod ships will be transferred to Taylor Maritime and Grindrod rundown. I don't know. I would think that probably they will make a sort of wholly owned subsidiary and then probably combine the fleet. Yeah, I would have thought so. But I don't know whether I'll do that or not. I'm not sure without looking at the full prospectus, which I guess is going to come out fairly soon. So that's that one. Harmony then. Sorry, let me go back up again. Sorry. This is a chart of the discount on the renewable energy sector, or what was a premium until relatively recently, and is now a discount. Obviously, the main thing that was affecting this was the rise in discount rates, so the foreseeable sort of rise in discount rates. That is understandable. Interest rates go up, then the denominator for calculating the net present value of your cash flows might go up too. There's been a little bit of evidence of that already in some NAVs, of people saying that we're pushing the discount rate up a bit. We've talked about this already in the past. There is no linear relationship between discount rates and interest rates, so there's no guarantee that they're going to go up a lot. But nevertheless, that there is a risk that this is going to happen and the NAV is going to come down. So that's one thing. But nevertheless, the sector's got a lot of other things going for it, and that was kind of offsetting that discount rate impact, and it was managing to trade still at a premium. And then the government opened its mouth, and they seem to be really actively anti-renewable energy, whatever they say, whatever Jacob Rees-Mogg says. The things that they're doing are basically sort of, no more solar on farmland, that sort of stuff. And it really is very unhelpful. And that now we've got this proposed price cap on the energy that they can sell. We don't know what that price cap is going to be. We're not going to know for that for weeks. And also, we're not going to know how that affects existing legal agreements to sell their power at prices above this price cap, whatever it's going to be. So that unknown is going to leave the sector trading discount, I think, for a while yet. And obviously, that creates a problem if you want to raise money. So for the battery funds, though, it doesn't really affect their revenue quite so much. So at the moment, most of them are earning revenue principally from the jobs that they're doing for the national grid. So they are there to stabilise the frequency of the grid. So if you've got a power station on the grid that falls off for whatever reason, then you need to inject power into the grid to keep the frequency stable. And that's a job that they do, and they get paid for that. If we do get blackouts, which seems quite likely, then you need power to help restart the grid again. So there's another job that they do, and they get paid for that. So those sorts of things are completely unaffected by what the government's doing. At least we hope so. One of the things that I haven't seen talked about, but in the back of my mind, I'm thinking might be an issue, is that at the moment, the trading activity that they hope to make money on in the future relies on quite big fluctuations in power prices through the day. And part of that is a reflection of whether the renewable things are generating or not. I'm not sure how price caps on that renewable energy will affect the volatility of intraday prices and the amount of money that can be earned by the arbitrage power prices. That's something that I think somebody else is going to have to elucidate. I don't know, Jonathan didn't thought about it yet, but it might be something that he needs to, as we'll come on to. So that might be one thing anyway. But so the battery funds are much less affected by this than the other ones. So there's less reason for them to be sitting on discounts. Nevertheless, Harmony is on a discount. It went to a discount very briefly because its NAV had a big jump upwards, and it took a while for the share price to catch up. And then more recently, it's been caught up in what's been going on with the government. So it wanted to raise about £130 million to buy 3 battery projects that would have substantially increased the size of its portfolio. The important thing with that, as we wrote about last week, is that those projects were all ready to go and they had grid connection dates lined up. So that means there is a very definite timetable they have to stick to get these things done and dusted. If they miss the grid connection date, that could be a disaster. Harmony's got right of first refusal to ever buying those things. Had they not been able to put up the money, then they would have been sold somewhere else. And it also got himself slightly back to the corner because of the way that the fundraising rules work. Its prospectus was going to expire on the 14th of October, and it wouldn't have been able to issue shares without doing any prospectus. So it didn't give itself an awful lot of time to raise the money. It was trying to raise the money while the ordinaries were on a discount. I explained in the previous thing why that's not necessarily a problem legally or practically, but nevertheless, they only got £15 million. So there we go. It's going to use that cash and it's going to issue some more C shares to actually buy the 3 projects. So it is going to bring them into its balance sheet. And then it's going to find another way of financing the construction of those. So obviously, the money that they need to finance construction is stretched out over the coming kind of 18 months. So they don't need it all up front. It says the investment advisor has already identified a way of doing this. We don't know what that is going to be. I'd like really the thing to go back on trading at a premium and then be able to issue equity to it and have all of the economics of that within the company. But nevertheless, this is probably quite a good way of doing this, and it probably does allow them to make some profit out of these investment opportunities, which is a good thing. So there we go. That's Harmony.